Insurance is both a product and an industry. We buy insurance to protect ourselves against potentially catastrophic financial risk. If you total a $20,000 automobile, auto insurance protects you from having to replace that car out of pocket. That would probably take forever, right? Insurance helps cover other losses that could spell financial disaster. That includes our possessions, our businesses, our health, and our lives. As an industry, though, insurance does much more. It actually helps safeguard our communities, our national economies, and global marketplaces. Insurance literally keeps the world going. For example, insurance losses for Hurricane Katrina, Wilma, and Rita totaled more than $117 billion, one of the worst insurance years in recent history. Without insurance, the people involved in those disasters and many others would have no hope of replacing property, businesses, or lost income from family members. Insurance offers many career paths, but let's review the three main types. Property casualty insurance is all about replacement and repair of personal and business property. It's also called liability insurance. This is what the auto, home, and business insurance companies offer. Life insurance covers expenses for survivors after the insured person has died. Most of us think of life insurance to cover family members, but businesses buy life insurance too for employees and for executives. It's all about safeguarding the income of someone who dies, and that matters to both families and companies. If you watch commercials, you'll see that some very basic life insurance policies are structured to cover only a few minimal costs, such as funeral expenses. Other forms of life insurance may cover greater sums for specific purposes, both business and family related. But that's not all life insurance companies do. They also create other products that allow people to plan for their future while they're alive. Annuities, for example, are financial products sold by life insurers that allow people to set aside money that will provide income at a later point in their life, particularly during retirement. The last category is one we've been hearing a lot about lately: health insurance. This insurance helps us handle doctor, hospital, and preventive care expenses that might overwhelm us financially if we become seriously ill. Anytime you experience a loss in any of these three types of insurance, you're filing what is known as a claim. And claims are where we really learn about how insurance companies operate. Insurance companies don't operate like charities. They're not just about helping you out of a jam. If you've bought auto insurance, you know that the premiums you pay are generally higher when you're a teenager for one important reason. Young people are less experienced behind the wheel and are statistically more likely to have accidents. Today's insurers track individual and business behavior in sophisticated ways. If you're a low-risk candidate, you're likely to get a lower premium rate than a high-risk candidate. In the past 15 years, risk management has gotten even more complex. Insurance companies now consider everything from weather and equipment risk to the chance of terrorism in their models, which are getting more sophisticated every day. That's why students with math, engineering, and analytical skills are so attractive in the insurance industry. They can gather data, quantify, and predict future risk. So, if risk is everywhere, how do insurance companies make money? Successful insurance companies do two things well. First, insurance companies that analyze risk successfully will do a better job of picking customers. That's why they hire actuaries to gather and study statistics so they can design profitable policies. And underwriters use the information provided by the actuaries to decide how much they'll charge you for insurance, if they decide to insure you at all. Big auto insurers, for example, scour an applicant's driving record before they'll issue an auto policy. Safe drivers get lower rates. Drivers with more of an accident history pay more. It's the same model for all insurers. Whether you buy insurance to cover property, health, or life, people and institutions with higher risk factors pay more. So an insurance company needs to decide which customers they can insure and still post a profit, either for their shareholders or members. And remember, every business wants to turn a profit. So, what happens to the premiums you pay? Well, they're a significant portion of the insurance company's income, but they're not the only money that keeps them afloat. When you pay your auto or renter's insurance premium, the insurance company puts that money in a wide variety of investments. That helps them handle all their business expenses, from marketing to payroll. But insurance companies need more than premiums to make a profit. They need to manage their own risk successfully. That's where reinsurance comes in. Reinsurance is insurance for insurance companies. In our Lloyd's of London example, we mentioned one of the biggest eureka moments in the insurance industry, when the earliest insurers realized they could all survive if they helped each other share risk. Simply put, reinsurance means paying other companies to take on part of the major risk. If a disaster happens, those companies share the loss equally, but in smaller amounts that the entire group can handle. That's known as sharing or spreading risk. In the next segment, we're going to take a look at career options in the insurance industry. And there are a wide variety of them. Thanks, and let's go on to the next segment.